Hello and welcome to Banking Transform, the top podcast in retail banking. I'm your host, Jim Marous, owner and CEO of the Digital Bank Report and co-publisher of the Financial Brand. An uncertain economy combined with technological advances, increased consumer expectations, and new competition will force banks to reimagine business models and rethink how financial services are delivered. More than ever, banks and credit unions must find ways to meet consumers' individual needs at speed and at scale. Continuous digital transformation is required across the entire organization. I'm really excited to have my friend Ron Shevlin, Chief Research Officer at Cornerstone Advisors and Senior Contributor to Forbes on the Banking Transform podcast. We are discussing how banks and credit unions must respond to the major opportunities in the marketplace today and try to avoid the threats facing financial institutions. In the just released report authored by Ron Shevlin, What's Going On in Banking, it was clear that the banking industry was concerned about the uncertain economy and the impact on interest rates and the cost of funds, while still being challenged to hire and train the right people. At the same time, there is a diversity of opinion on how to respond to the opportunities of real-time payments and the speed of digital transformation. The question continues to be, how does a bank, credit union, or a fintech firm become future ready? So welcome back to the show, Ron. You know, we have conversations on an ongoing basis, but it's always great to have you as a guest early stages of each year, helping to set the stage for what the banking industry should actually expect going forward, or what we think they might have to expect. So in your report and in your research, what would you say is the most important trend that we'll see emerge in 2023?
Well, Jim, first, thanks a lot for having me. Appreciate being on every year. I've been wrong every other year, so I'm not sure why this year will be any different. But thankfully, I've got no shortage of opinions on those things. I think there's a couple of things, though, that the survey of about 300 mid-sized bank and credit union executives will show that this year's will merge as trends. On one hand, there's just, I don't think, any question that real-time payments is going to become a lot more of a presence in the industry. We're expecting FedNow to release and launch something this year. No question about that. The other thing I would have said, if you had asked me this about a week ago, I would have included chatbots and AI. I think maybe you'll want to get into this in a little bit more detail, but I think the launch of ChatGPT a few months ago just lit a fire under a lot of financial institutions to say, wow, maybe we're missing something here and really need to take a look at it. The data that we've been looking at for the past couple of years, Jim, has certainly shown an increase in the deployment of chatbots, predominantly by credit unions, probably not surprisingly, because they tend to be more consumer focused. But I think the smart banks are also beginning to understand that chatbots aren't just sort of frontline, answer the easy question things. They're actually very employee facing as well. So I think that will be a big trend as well. And you can't go wrong in this industry, Jim, by predicting that digital account opening is going to be a big trend. It does not end. It continues to be at the top of the charts of the technologies that banks and credit unions plan to invest in.
It's interesting. In your report, What's Going On in Banking, it spells out a lot about how the industry is responding to change. What was your biggest surprise from your research, and what's the most glaring gap that you see between where financial institutions need to be and where they are today?
Jim, this could go on. This discussion of this question could take up the rest of our time, because if there was a surprise and a gap, it has to do with digital transformation.
Yep.
I've been asking for the past couple of years, do you have a digital transformation strategy, program, initiative, whatever it might be? And how far along are you in that? And so one thing, on one hand, Jim, I see a large percentage of financial institutions who don't seem to be making a lot of progress in that. But on the other hand, I think I'm beginning to come around to the belief that there is no end to a digital transformation.
No.
And so I think the gap for me, and this is something we could probably debate and argue with for a long time. But you listen to a lot of folks talk about digital transformation, and there's a line of thought or reasoning that says, well, digital transformation is a lot more than just technology. It's about culture and all those things. And I have resisted that for a couple of years, and was actually at the Bank Director IOBA conference just a few days ago that I came back from, that I think I've kind of codified my thoughts around this. But I think a lot of financial institutions who have digital transformation programs, initiatives, whatever they might be, need to distinguish that from the idea of digital modernization, because there is clearly a technology component to this.
Yep.
And it isn't necessarily about ripping and replacing your core system. It is about core workaround strategies. It is about modernizing the architecture, if not the core. But I had said something a couple of years ago that I had written, said, can you really say that you've digitally transformed if you haven't replaced your core? And now I'm coming around to the belief, if not realization, that you really can't say that you've digitally transformed if you haven't created some form of digital modernization and workaround strategy, because I don't think necessarily you have to rip out the core. So I think was kind of the surprise, was the lack of progress on digital transformation and the gap, I think, between where they need to be and where they seem to be.
It's interesting. We do research on the same subject, and we've actually seen the number of organizations that say they are they're mature in the digital transformation process go down. And I don't think it's like they're not doing things. What the problem is, they're not doing things fast enough. So what happens is, where they need to be based on the consumer, based on the competition, based on what we know about what needs to be done, they're almost ending up farther away because they're not moving fast enough. And to your point about, is it ripping out the core? Where do you focus? I think initially everybody thought digital transformation was a project as opposed to a process that's really never ending. There's no end point to this. The finish line is going to continue to get away from you, but how much further it's going to get than you're going to catch up to it. The other part is so much attention was spent on the top of glass as opposed to the below the glass. And I think, those organizations the furthest along realize that if they don't digitally transform their processes, their procedures, their back office in a full sense, not just the technology, but the way they do things, they're never going to get there. And you brought up earlier, digital account opening. I get frustrated every time I talk to an organization that says, well, we partner with a really good firm to bring our digital account opening process up to date. And then you realize that the first thing they do is they bastardize the process that the solution provider has created that lets them avoid using driver's licenses, for instance. As soon as they say, well, I like what you have, but we got to stick with the driver's license as the know your customer component, you've already added 4 minutes to 5 minutes on the process as a starting point, not including anything else. So again, it's rethinking what's necessary and actually being willing to accept some of the solutions that are out there that can really make you digital ready. It's a big question mark out there, and as your study showed, the number of organizations that felt they were moving forward fast enough was very small. And do you think it's going to get any better with the economy being still uncertain? Is that going to be an area where people are going to actually maybe scale back when they shouldn't?
Well, I don't think they will, because the cycle of the economy right now is causing deposit gathering to be such a huge objective and goal for the year. So I think they're going to try to accelerate that because they'll want to take advantage of easy digital account opening in order to gather some deposits. So it might light the fire under them, I think, this year, Jim.
Yeah. As you mentioned, there's been a lot of innovation around payments. I've mentioned in a previous podcast that I was at a payments event, and when we asked for, and these were big organizations, asked for how many of these organizations were going to implement real-time payments upon the availability of doing so, like nobody raised their hand, which astounded me. I looked and I'm thinking that I was hearing the question wrong. And what it was is a lot of organizations were thinking, well, we'll see what happens and then we may jump on board. But taking that a step further and looking at what else is going on in the marketplace in the payments area, you touched base on it in your Forbes article a week ago around the biggest banks coming together to offer a wallet. And the gist of the article from where I read it was you said a big boo-ha-ha about nothing. It's not going to transform the industry. Can you describe that a little bit about your take on that?
Yeah, I think I was very negative about the prospects of a big bank developed digital wallet. And that's not to have any slight at Early Warning or Zelle, which has been very successful. But if you let's look into the success of Zelle for a moment. I had somebody argue with me on LinkedIn past couple days that I was too negative about the prospects for this digital wallet. And his point was, look at the success of Zelle. Well, Zelle has been successful for a couple of reasons. They've done a great job of marketing and getting this, out into a lot of other financial institutions. But number one, part of the success of Zelle was that there was an existing transaction base. Remember, on day one of Zelle, there had to have been millions of transactions because everything that the big banks were doing on around P2P were on day one now classified as Zelle.
Correct. Yep.
Second, I think big driver of Zelle's,
also, if I'm not mistaken, A to A, account to account transfer.
Yes, and account to account too.
Yeah, right.
Even more kind of
right.
Not ridiculous, but even more. So number two driver of success for Zelle has been the demographic adoption among, let's say, people closer to age to you and me, Jim, baby boomers, who were not doing P2P through Venmo or maybe not PayPal or any other P2P platform. So question is, who's using digital wallets today? Where is the growth opportunity for it? And similar things. So are they going to be able to steal share from the Googles, the Apples, anybody else doing digital wallets? That's a tough road to hoe. Row, right? Not road. Yeah. I don't know what that saying is, but you know what I mean.
That's a good. I don't think I can give you the answer to that one.
Yeah, I say that a bunch of times. I'm always getting corrected. So that's a tough path to go down. Let's call it that way. And then second, are we really going to see huge adoption among non-digital wallet users today? And just looking forward and looking at, and Jim, we talk about this all the time, how consumer behavior has changed. The idea of 20 years ago of having all your accounts at one institution in one place never succeeded, and is even worse now as younger consumers, let's say under the age of 45 or 40 even, have 30, 40 different financial relationships. I think it's a really steep hurdle for the big banks to get over to kind of drive that change. Not to mention, why are they doing this, Jim? They're not doing it because of consumer convenience. They're doing it to drive more volume. It's not a real customer-centric type of solution that they're going to come up with. I may, a year from now, listen, please get me back on to tell me, hey, Ron, look how wrong you were.
Yeah.
But I don't know. I don't see them overcoming the hurdles of changing existing digital wallet behavior, and number two, driving new usage among consumers who are not big digital wallet users today.
Well, and I guess the good news is they decided not to try to jump through the hurdle and get retailers that are not online involved, because that brings just even a bigger hurdle out there if you try to get the small business to accept your wallet on the front end. I think the biggest interesting thing from a standpoint of being an old-time banker like you and I are, is that what they're doing is they're trying to capture insights around payments that consumers are making that right now show up just as an Amazon payment. That doesn't show what they bought, doesn't show anything about what they've done. And if you're owning the wallet, you get that additional insight. The problem is the horse left the barn. And I'm not even sure if that's the right saying anymore. But the reality is it's too much, too little, too late. And I continually roll my eyes whenever I hear any banking organization, big, a consortium, a big bank, any bank, talk about something to introduce in another 6 months now, and said they've been working on it already for 6 months. I'm saying, well, then the first 6 months are already going to be outdated. And why do you talk about introducing something in advance? I've just never figured out, but that's the industry that we're in. So
one last comment on that, though, Jim, before you move on. There's an aspect to this, too, that just doesn't add up for me. With P2P payments, if you're Bank of America and you're in this consortium with Chase and Wells and other large financial institutions, they're not going to switch checking accounts between those because of the geographic and limitations and all those kinds of things. However, how many consumers, and I'm one of them, who has both a Bank of America issued card and a JP Morgan Chase issued credit card? So a digital wallet that contains both, it creates an inherent conflict of that the consortium partners are now fighting with each other more for that behavior and that activity, and that just doesn't seem to me to be sustainable.
Yeah. Switching a little bit, in our research we've done for the Digital Bank Report, we've obviously seen an emphasis on the use of data analytics and advanced technology, a greater emphasis on it. Where do you see the impact of the emphasis on personalization and data really impacting banking in 2023, or will it be simply the largest, and I'm going to say it's largest and the smallest banks, the ones that are actually have the funds to do something, and those that are partnering to get it done?
The biggest impact, Jim, I think, is going to be on product design. I think there's a limit to how much personalization they can continue to do on, let's call it, customer experience. To a large extent, that's kind of driven by your platform, choice of platform providers. And there's some things, of course, that they could do. But I think there's a growing recognition among mid-sized financial institutions that they need to differentiate on something other than just simply the customer experience, especially the digital customer experience. Their hands are tied because they're relying on vendors and providers. Those providers might be very good. I'm not saying that they're not delivering a great experience, but they're pretty much delivering the same experience for every institution that they support. So this isn't just where the impact of personalization is going to see itself go, but it's really where the opportunity is in the marketplace to differentiate the products, not just the customer experience.
Well, and I'm also moving more and more towards those organizations that are most progressive are going to move beyond experience to engagement. I mean, using data and technology to get more interaction between the consumer and the financial institution. But again, I'm seeing organizations still focusing so much on having good information as opposed to good implementation, good impact to the consumer. There's a big leap between being able to show an organization everything about their consumer and show it in a nice, visual way, and another to actually deploy that in the marketplace at speed and scale to say, I'm going to be talking to Ron when he's most likely wanting to be talked to. That's a big leap. I mean, and the banking industry to this point hasn't shown a real good ability to do that, even though they may know everything about me. You recently also in an article you wrote for Forbes, which again, I recommend everybody, follow Ron on Forbes every week. And sometimes more often he comes out with some great insights into the banking industry in his own humorous way to say, is this going to work or is it not? And it's a great insight into what you should do next. But one of the things you talked about was, as you mentioned earlier, the future of tools such as ChatGPT. What do you see as the future? And, there's a lot of people that have been naysayers, but I think they wanted perfection out of the blocks, and that's not going to happen. What do you see as the future of tools like that?
Well, I just published, yesterday, latest FinTech Snark Tank post proclaiming 2023 to be the year of the chatbot in banking. And when I put that into my predictions post about a month ago, I was probably the least well received prediction I've ever made. People were like all over me on that one. All right, great article, Ron. I don't know about that chatbot prediction though, but I'm sticking by my guns, not literally, of course.
Yeah.
But I'm sticking with that, Jim, because it's more than just sort of a frontline customer support tool to handle the easy questions. This is, first of all, we got to really distinguish with some terminology here. The underlying technology is conversational AI, and machine learning is kind of part of that too. That might be a separate. You may think of that as a separate technology, but what I'm really thinking is that these two technologies kind of merge into something we call chatbots. But I had published a report a couple of months ago called The Chatbot Journey, which talks about how financial institutions will start off with relatively simplistic chatbots that, just answer a question and then maybe you answer another question, and kind of evolve and grow to what a lot of folks in the industry would call an intelligent digital assistant. I don't like that term, but there's clearly a difference. And so I think thanks to ChatGPT, I think a lot of financial institutions are getting to see the potential use cases for these technologies well beyond just sticking it on a website or a mobile app and as a front end buffer before they get to people. I mean, that's what the phone trees have become. They're barriers to getting to people.
Yep.
And that's not where we're going with this. Where we're going with this is, number one, having a tool that's actually can have a conversation with a customer or somebody else, where it's not just simply ask a question, get an answer. Okay, ask a different question, get a different answer. It's really more about having a conversation. And then number two, actually bringing somebody in, another human from the bank side, who can pick up on that conversation. But
Yep.
Jim, I think where the smart banks are seeing the opportunity is in understanding that this technology, and I keep wanting to not call them chatbots,
Right.
but this technology can support employees as much as it supports the customer. Can be an internal facing tool. I interviewed a lot of firms for this report that I wrote, and a lot of them, Jim, talk about making their chatbot a member of the team. When I first heard that, I was like, groan, oh, really? How hokey is this? But after talking to them, and these are some really sharp people, I'm like, I began to understand how they're, trying to infuse their technology, their chatbot, with a personality, and how they want that chatbot to be utilized by other employees as much as sticking it in front of the customer. For anybody who is interested in this topic, I would suggest you go to LinkedIn and find an article that Chris Nichols from South State Bank published last week sometime on 15 use cases for ChatGPT. And these are all internal-facing things. These are not customer-facing applications for it, but really interesting ways that his colleagues at South State are beginning to use this technology. And I do think, Jim, that's really going to light a fire under a lot of financial institutions to say, this is not just a simple thing you put out in front of customers to deflect interactions going to the contact center.
Well, I think also what's interesting is for those organizations that have developed great content, good wellness solutions, good ways of financial managing your money, things of this nature, this chatbot can then integrate what those learnings are and also point you to other parts of the organization. And as you said, how good is that for an internal employee that really doesn't even know what kind of content their organization offers, where this becomes part of that whole discussion point. And, for those organizations who want to try to catch up to Erica by Bank of America, this is their opportunity, because Bank of America's got 5, maybe 7 years of advanced learning on how the interaction between a consumer and a chatbot can go, and the advantages towards making those into sales opportunities, solution opportunities, recommendation opportunities. that's a good way to catch up is this technology. And, from what OpenAI has said about how this whole technology is going to transform this year, we have to watch out because it's going to be honest. And what's interesting is every consumer right now is already talking about it, which you don't see that very often in technology upgrades where, everybody's talking about what this is and what it can do. And some of it's scary, but there's a lot of opportunity here. Going to go back to another article you wrote because you've done a lot at the end of the year and the beginning of this year. You wrote a recent article about how the future of fintech firms may be as potential partners for community banks as VC money has dried up, but as the innovation that's needed within community banking environment really has ramped up. So it's a perfect storm almost. Can you discuss a little bit about what your article said and what your belief is on how the bank and fintech collaborations can take place?
Yeah, for the past couple of years in the What's Going On in Banking study, I've been asking banks and credit unions about their fintech partnership activity. This year, I asked them to quantify how much they are investing in fintechs. Consistent over the past couple of years, there is about a quarter of the respondents who say that they are making investments in fintechs. And now, sorry, Jim, I got to do a quick disclaimer here and explanation on things because it really became clear to me this year. I do this study every year and it's, want to say, a quarter of the banks, a quarter of the credit unions, but it's never really a quarter of all of the banks or all of the credit unions. My sample is very much, first of all, it is not representative of the overall population of banks or credit unions. 4,000 banks, 4,000 credit unions, there's no way that my data is representative of that total population. But what I do believe is that there is a segment of the banks and credit unions. My colleague, Steve Williams, co-founder and president of Cornerstone, likes to call this group the troublemakers. The group that are, really focused on technology as an enabler and a differentiator, who are not just sitting back and doing nothing. And so I really think my sample is very focused on that segment of the bank and credit union population. And so when I say a quarter of them, it's not a quarter of the 4,000. It's a quarter of the 1,500 or so troublemakers in the industry. And so about a quarter of them past 2 years have been making investments in fintech. And that average per institution investment is increasing from $3 million per bank last year to $4 million this year. And that's a lot of money. And I've estimated that's close to $2 billion. And when I look at the allocation of VC funding into fintechs by category, clearly the VC funding has gone into a lot of direct to consumer or direct to customer, direct to small business. But there's a category of fintech that some people and I like to call it enterprise fintech. It's the fintechs who support the financial institutions.
Right.
And that's predominantly where the banks are investing. And they're not, Chase has thrown some money into potential, competitors that they might end up buying. But for the most part, mid-sized banks are investing in fintechs that are developing technology that will support the banking industry. And there's a lot of money going into that. And I think they may be becoming one of the primary sources of funding in that category.
I would agree. And I think what we've seen as well in our research is that, I'm going to expand fintech to saying third-party providers because it really is changing quite a bit. We talked about the new account opening. We've talked about payments. Most of these organizations realize the best way to make headway in this quickly and at scale is to partner with an organization that's already gotten there. Which is what the fintechs are and third-party providers. It's going to be interesting to see what happens because I think everybody knows they've got to change the way they do things, be it in the term digital transformation or not. But it's going to be interesting to see how those troublemakers go well above the industry norm as far as success. And we're going to start to see the differences, I think, and it's going to be interesting to see what happens. So let's take a short break here and recognize the sponsors of this podcast. This show is sponsored by FIS. So how do you find your feet on ground that's constantly shifting? You have to read the Global Innovation Report from our partners at FIS. From embedded finance and ESG to crypto, decentralized finance, and the metaverse, FIS pinpoints the trends you need to watch and explains how innovation can give you an advantage in good times and bad. Discover how the latest innovations can affect your business. Explore research today by visiting www.fisglobal.com/global-innovation-report. FIS, advancing the way the world pays, banks, and invests. Welcome back. I'm joined today by Ron Shevlin, Chief Research Officer at Cornerstone Advisors. We've been discussing financial services trends for 2023 and what the industry must do to become more future ready. So Ron, there continues to be a lot of talk around digital transformation in banking. We talked about it at the top of the podcast. Yet the pace of this transformation differs immensely between one organization and another. To be prepared for the future, where do organizations have to put their big bets on today?
I'm a consultant. I've been a consultant for a long time, Jim. And so I have perfected the answer. It depends. It depends on where they're at and where they're going. And I think for a lot of financial institutions, and especially, those below the top 10 who, cover so much of the industry and so much of the population, it's really time for a lot of mid-sized institutions to really make sure that they know who they're serving. And one of the challenges, and I know get a lot of pushback on this, to say geography as a community is dead is a little overblown, but it's the direction it's going. And so understanding who are you really serving? What are the consumer segments that you're going to specialize and focus on serving? Which of the small business segments are you going to serve? It is really kind of the starting point. And without that lack of clarity, Jim, I think a lot of financial institutions just sort of, fumble around on things and just kind of move forward and try to, improve processes and improve this or that. But the big bets have to be made on certain segments of the population that you want to serve from both a retail and consumer perspective, and understand what are the products and set of services that you've got to differentiate on to deliver that. There's always a set of products and processes that everybody has to do, and you've got to stay up to speed on those things. But those aren't bets. Those are just costs of doing business. The bets are on the segments and the products and services that serve those segments.
So let's take the opposite of that. And we talk about this sometimes that, the stop talking about this, just shut up. It's not something you should be thinking about right now. What are some of those things right now that organizations like to dabble in discussions around that you just go, just stop? There are so many things that have to come before this. What are some of the items that organizations in 2023, at least as certainly the mid-sized and small organizations, just should not even spend one moment of awake time with it? How about crypto?
Yeah, well, that was just kind of the first one that comes to mind. But here's what I wrestle with, Jim, is that there are things that you need to do in 2023 that or banks need to do in 2023 that isn't going to pay off in 2023. Right. And waiting till 2025 to do it when everybody is like your comment earlier about Bank of America and Erica. Yeah. When they started this, 5-6 years ago, whatever it was kind of like, really, why are you doing this? But okay, they made the commitment. We will still see if it pays off. But Jim, if I'm talking to a board or an executive team at a strategic planning meeting, and if they would ask me that question, what do I need to stop doing? It's like, you can't answer that question without the context of the strategy and direction answer. And so
it's kind of like what you'd say with metaverse, in that, you may not be having to build this virtual branch, but you better keep learning in that area.
I'm glad you brought that up because that's a great example. I would say that to 99% of the financial institutions that I'd probably get a chance to talk to in 2023, I would tell them, don't bother with the metaverse in 2023.
Right.
Having said that, let's take a look at Coastal Bank, Eric Sprink, Kurt Carews. Look what they've done with Coastal World. And they've built a metaverse capability, platform, whatever it might be, to engage consumers to help drive engagement with their ecosystem. So they did it. They utilized this new technology, but it fit with their strategy, Jim. And last year I really took Fidelity to task. They had launched this, metaverse thing, and it was just god awful. It was, stupid. It was a bad game. It was, it was kind of bad because it didn't fit the strategy. They wanted to drive investment in a particular type of investment class. It was like, this wasn't going to work. Who's going to use this? 45-year-old people? No, come on. But even though the utilization from a demographic perspective might not be there with older consumers, Coastal built a capability to help people understand who is in their ecosystem and have a tool to drive that in a engaging way. But is that going to be right for 99% of the other financial institutions? No way.
You've been in banking almost as long as I have. A lot of times I'll look back and go, man, so many things have changed. I came in at the beginning of ATM cards, they weren't debit cards, they were ATM cards. And I came in the beginning actually of the credit card, which is really going back. But sometimes I go, gosh, as much as things have changed, there's certain things in this industry that just completely freak me out that they haven't changed, that we're still battling the same battles. What surprises you about what hasn't changed since you got into banking?
It's funny you should bring this up. At the AOBA conference this week, I ran into an old buddy of mine, Jamie Punishel, who is now Chief Market Officer at Encino. He and I worked together years ago at Forrester. He left Forrester, went to consulting, then went to Citibank for a while, really drove probably the best PFM implementation there ever was, and Citi just let it sit on the shelf and die. And then pretty much Jamie left the industry until about 6 months ago when he came back to Encino. And we were chatting at the conference, and he said, I'm listening to all these presentations at the conference, and it really strikes me that nothing's changed in 20 years. There has been some terminology change. He said, 20 years ago, we were wrestling with, we have to automate everything. And now we have to digitize everything. And he goes, what's the difference? We're still not there. But I think, Jim, beyond that, the thing that I would say from a personal perspective that hasn't changed, that really drives me nuts, is the lack of understanding that technology in and of itself can drive relationship. It does not relationship does not have to be purely person to person, human to human.
Right.
It can be technology intermediated, or it can be completely technology. The founder of Commerce Bank in New Jersey, I'm blanking out on his name. I'll remember it as soon as we end the recording.
Who went over to Europe?
Vernon Hill. Vernon Hill.
Yep.
Vernon Hill was quoted years ago as he was asked why his bank wasn't making big investments in online banking. And he said, because nobody wants a relationship with a machine. Very pithy. Yeah. I'm not going to get nearly the exposure he got with that response, with my response, which is nobody wants a relationship with a brick. It isn't about the brick. It is about the value you get from this products, services, and interactions. And if listen, I got bad news for a lot of banks, Jim. Their technology interactions are better than their human interactions.
Look at chat. We talked about it before, but Chat GPT, you could end up having them being much better. That's what humanizing banking is. It's saying, can you listen and respond? I mean, that's what people want. They want interactions, not just transactions.
Jim, there's a huge problem, and this might be a good transition to another topic I know you wanted to talk about, but there's a huge problem in the industry right now, and that is s- skill levels of staff.
Yeah.
The pandemic saw a lot of, the 30-year-old, 35-year employees, Sally and Betty at the branch who knew you and knew everything about the bank's products and services. And they retired. They're out. They're gone. And who's left? People with, I always joke, they have 5 minutes of work experience, 5 minutes of experience with the institution. They're just not as good. My wife, who handles the banking, and you know my wife, and you can imagine what, the hell she gives them when she walks in there. It's just frustrated every time. It's she not only knows more about finances, but she knows more about their own products and services than they do, because we've been a customer for 25, 30 years. So you've got to use the technology to develop relationships. That view, Jim, has not changed in a long time, and there's just not enough people who are willing to adopt this new philosophy.
Okay, so not going to be a quick answer, but maybe we can get it done quickly. Is that how do organizations upgrade, update, train, immerse their employees into what they're needing to do to be successful in a more digital environment?
Well, number one, stop requiring everybody to be in the office and recognize that the skill sets and resources that you may need is going to come from people 300, 500, even 1,000 miles away. And you just don't have the luxury anymore of drawing on local talent. Without
and don't need it, actually. It's not even a luxury anymore. The luxury is getting the right people for the future that may not be in your neighborhood. Yeah.
Yeah. Second, you've got to figure out what you really have to be good at. One of the things, I think it was somebody maybe at the conference said that really stuck with me, was he said, look, if you're a mid-sized bank, you can't build it all, but you might have to integrate it all. And so understanding what skill sets you really need. And I think, Jim, looking out for the next couple of years, not only is there a set of technology skills that banks are going to need, but I think they're going to need a lot better human skills in things like integrated health. One of the things I'm concerned about from a bank perspective is that they talk a good game about financial health. But I think if you look at other like HMOs and people companies outside the industry who provide health, there's a much better recognition there that there is sort of this triad of physical health, mental health, and financial health that really plays into each other. Yeah. So I think, a lot of banks are going to need people that are like financial therapists. And it isn't just some fancy label you slap on somebody. It's somebody who really has an integrated set of skills. Not going to be easy to find. They're not going to be easy to develop, but you've got to decide, is this an investment we need to make to serve a particular segment of the segments of the market that we want to address?
Finally, Ron, what's the biggest opportunity in banking today?
I think the biggest opportunity is to find and serve a niche of the segment of the customer base, whether those are consumers or businesses that are either untapped or underserved today, with products and services that are unique to that or those segments of the market, where somebody says, oh my gosh, I can't believe you do that. Nobody else does that. You're the one I want to do business with. And you know what, Jim, and we can argue this, but I don't care if they use analytics and if they use some advanced technology to do it. If you're providing a set of products and services that are unique to a segment, that is going to really attract that segment, and they're going to be willing to deal with or accept some shortcomings you might have in other technology areas because your product is so good and so specific for them. I think there's a lot of opportunity in the banking for financial institutions to find and serve those niches.
Well, and to take out of their mindset that it's got to be just in their community. I mean, KeyBank's done a really good job at finding niches in the medical community and saying, we'll go globally if we have to, but certainly within the United States to serve the individual doctor better than anybody else. Again, you're not looking at simply the people that can come into your branch. The digital world gives you so many opportunities. I think you have a great point there that you've got to find that niche you can serve them better.
That's the point, that affinity is the new community, not geography.
Yeah.
And I think that's the key point.
And before we leave, word on the street is that you're going to be soon introducing a new podcast. Can you give us a little bit of insight into what that's going to be and what we can expect?
Sure. So we had talked before that for the past number of years, I've been producing a report called What's Going On in Banking. I've decided to extend the brand and create the What's Going On in Banking podcast. We already have 2 episodes under our belt that's out there on Spotify and all the popular platforms. But let me just give you 30 seconds on why it's going to be different. I did not want to compete with the Banking Transformed and the Breaking Banks of the world, so I have a very different format. Instead of a kind of talk show, let's get a guest on and kind of chat, the focus of all of the episodes will be on some breaking news in the industry. So the first episode was about the OCC acting comptroller, indicating that they had developed a framework for breaking up the big banks. So I got Rob Blackwell, Chief Content Officer of Intrafy and former Editor-in-Chief of American Banker, to discuss that with me. And the second episode was about the announcement, as we had talked earlier, about the introduction of the digital wallet from the consortium of big banks. And Scott Harkey from Endava, who's a brilliant payment expert in the space, got on with me. 15 minutes to 20 minutes tops discussion on one topic and what's going on, and much less of an interview style and much more of, okay, here's what I think, tell me why I'm wrong, John McLaughlin style, wrong, So 15 to 20 minutes on specific topics with people who are experts in that topic.
That's great. It's always good to expand the brand, but also to talk about current information, because there's no lack of content out there that needs to be talked about, and these things that even in your way of doing it, which is looking at what the industry is doing and going, you guys are thinking the wrong way. And, that's going to be really entertaining. I'm looking forward to it. So again, Ron, thank you for being on the show again. You are the guest we've had on more than anybody else, but there's a good reason why. I mean, it shows by the discussion we've had today, there's so much to talk about, and you really do have your finger on the pulse of the industry. So I appreciate your time.
Thanks, Jim.
Thanks for listening to Banking Transformed, the winner of 3 international awards for podcast excellence. If you enjoy what we're doing, please take 30 to 45 seconds to show some love in the form of a review. It really helps to grow our platform. Finally, be sure to catch my recent articles on the financial brand and check out the research we're doing for the Digital Banking Report. This has been a production of Evergreen Podcast. A special thank you to our senior producer, Leah Haslage, audio engineer, Sean Rowe-Hoffman, and video producer, Will Pritz. I'm your host, Jim Marous. Until next time, remember, banking transformation is not a project. It's an ongoing process of modernization for survival.